Accounting superstars, welcome to the channel. It's great to have you here. This is the place to learn accounting. I'm Professor Don Bush. I've been teaching accounting for about 30 years, and I've been a CPA for about that long also. So today we're going to learn about deferred tax assets. This is our first lesson. If you have been watching the previous videos on deferred tax liabilities, this lesson will be so easy. There's nothing to it. So we're working with, when we get to it, construction. The construction company that you do not want to have come and work on your house, because when you ask them, when are you going to come out to the job site and get some work done? They answer, when we get to it. So that's how they got their name. So here's what's going on today, ladies and gentlemen. So what we have here are two charts, and the first chart is based on generally accepted accounting principles. And if you're in intermediate accounting, you ought to know by now that we recognize revenue as we earn the revenue. We try to match expenses with that revenue. Now the IRS in the second box, they don't work that way. They don't really care when you earn the money. All they care about is when you do get the money, the government wants to share that money with you. So it's kind of like you've got partners here. So here's what's going on, folks. When we get to construction, they have been asked to be on a reality TV show. It's about construction, and there'll be all kinds of drama and that kind of thing. So here's what's going on as far as revenue. With revenue, according to the generally accepted accounting principles, when we get to a construction is going to recognize revenue as they earn it. And they're going to earn this revenue over 4 years, and it's going to total $500,000. So to say it all another way, they're going to earn their revenue evenly each and every year, and they'll get a grand total of $500,000. So this is according to generally accepted accounting principles. And they have an income tax expense, and the rate is 20%. So their pre-tax financial income, $65,000. If you multiply that by 20%, you get $13,000. So every year, they will have an expense of $13,000. Now that doesn't mean they're going to pay in $13,000 to the government, but according to generally accepted accounting principles, trying to match expenses with revenues, that is what the income tax expense will be. It all totals $52,000. Now coming down to the IRS regulations, the tax code, filling out tax forms, it's a different story. So when it comes to revenue, when we get to it, construction is going to be paid $200,000 in advance in the first year. And then they will be paid $100,000 in the following years, with a grand total of $500,000. Now this $500,000 matches what is going up under Gaap. So we have a total revenue of $500,000. Total revenue of $500,000, but the only difference is, according to the IRS regulations, they are getting paid $200,000 up front in advance. The IRS regulations and the tax code, if you're trying to make sense of it, it helps to think that a lot of times the tax code is on a cash basis, because the government feels, when's the best time for you to pay taxes? When you get the money. So when we get to a construction, they're getting paid $200,000 right up front. That'll be considered taxable income, and they are going to have a hefty tax bill of $28,000. Now that's much different than the tax expense according to Gaap, because with Gaap we are recognizing revenue evenly over the 4 years. With the IRS regulations, we're not recognizing income evenly. We're recognizing income when we get the money. Now in later years, like in year 2, the revenue will be a cash payment of $100,000. So the IRS says, oh, you're getting paid cash? Well, let's pay some taxes. And the tax for 2002 will be $8,000. But according to Gaap, the income tax expense will be $13,000, and again, that's because they're dividing up the revenue evenly. and so on and so forth for the following years. And the total tax to be paid for this reality TV show is $52,000, which matches the amount in income tax expense. So to put it one other way, in the first year, it is very much like they are paying taxes in advance, in a sense. And since they're paying taxes in advance, which is one way to look at it, they will pay less tax in future years. So let's go down to the next chart here. So far, so good, I hope. So this third chart is just a summary of the top two charts. And what we have is in the first line here, income tax expense according to Gaap. I just got it from this top chart. As you can see, we've got $13,000 every single year here. There we go, $13,000 and so on and so forth. That all adds up to $52,000 as it did right up here. In the second line, we've got income tax payable. I got that off the second chart, according to the IRS regulations. And the income tax payable is quite different each and every year than Gaap, but over the long run, it all adds up to the same. So the difference here in the first year is $15,000, and then this difference starts to be reversed out. So we have a $15,000 difference in the first year, and we have $5,000 reversing out, another $5,000 reversing out, and another $5,000 reversing out. So in the end, the grand total is 0. They cancel each other out. So here are the journal entries. And the journal entries will be super, super easy if you follow the deferred tax liability lessons. So here we go. Here's the first entry. I've got them color coordinated. I'm going to split the screen here so it makes a little bit more sense. Here we go with the journal entries. The income tax expense for the first year, it's all in yellow, $13,000, got it right from here, from the chart. Income tax payable is $28,000, got it right off the chart. And the deferred tax asset is the difference between the two, and it's an asset because assets are debits, folks. And so we're going to call it a deferred tax asset. Another way of looking at it is in the future we will pay less taxes. So it's going to save us money in the future. Coming down to the partial balance sheet, the deferred tax asset is $15,000. Right there it is. It's a long-term asset, folks, not a current asset. Coming over here to the Gaap income statement. I got this off of the top chart, but here's how the tax section works. The current is how much we have to pay right now today. We have to pay $28,000 to the government. Of course, we want it to end up being $13,000 as the expense. So here's the $13,000. So the only way to make this work is to subtract out the deferred tax asset, and it'll work out here. So we've got listed how much we're paying this year, subtracting away how much is being deferred, and we have what the expense is for the current year. Now, if you follow that, the next 3 years are super easy. In fact, they're almost identical. So here we go, $13,000 is the expense. What we have payable is $8,000, and we're reversing out the deferred tax asset, so that way our journal entry balances. The deferred tax asset is going to be $10,000. How did we get $10,000? Well, it's $15,000 minus the 5 here, or the difference between the two here. And coming over here to the Gaap income statement, current is how much we have to pay to the government this year. There it is, $8,000. The income tax expense is $13,000, and we have it right there. And the difference is what is deferred, so it's being reversed out. There we go, 8,000 plus 5 is 13. So here we are in the pink, same thing, $13,000 expense, $8,000 payable. What is deferred is 5. And on the balance sheet in long-term assets, deferred tax asset is 5. The Gaap income statement is identical, folks. $8,000 is what's payable this year. $13,000 is the expense, and what is being deferred makes it all work out nice and even. 8 plus 5 is 13. The last year, and we are done. Here we go, last year. Income tax expense, 13. Get it right here off the chart. What is payable this year is 8. and we're reversing out the deferred tax asset. The deferred tax asset here is 0. Why is it 0? Because it is completely zeroed out. Here's a negative 15, positive 15, negative 15, positive 5, positive 5, positive 5. It all nets out to 0. The income statement is identical to the last 3, so I don't need to go over it. So ladies and gentlemen, if you found this video helpful, let me know. Hit that like button and also subscribe to the channel so that way you know when new videos are coming out. And by the way, it would really help the channel out, because that way I know that you guys like this stuff and it's helpful. Also, YouTube will know that you like this stuff and it's helpful, and they will share this video with more people. So thank you so much. Have a great day. Over and out.